Welcome to Friday's weekly wrap-up. I'm Elaine Stenson. The October FOMC statement was out this week and no surprises, as the committee said it would refrain from tapering its quantitative easing programme because it needs more evidence before doing so. I'm joined on the line now by Vincent Cignarella, currency strategist with the Wall Street Journal in New York. Vincent, this was the main event on the economic calendar this week. What can we take from what was said, and did it give us any more insight to when tapering might be introduced?
Well, the big takeaway, I think, was what wasn't said. At the previous meeting, there was a statement about tightening financial conditions. That statement was omitted in the October in the last minute's release. Primarily, I think, because the 10-year bond yields came down a bit. After Mr. Bernanke first mentioned the possibility of tapering in May, 10-year bond yields had jumped from basically nearly about 150 basis points, and they backed off in the last month or so. So that being said, that statement being omitted let traders and investors believe that potentially they might be moving faster and they might do something in December. So that's what's kind of gotten the market spooked a little bit.
Okay, and moving over to Europe now, and index provider S&P Dow Jones has cut Greece from developed market to emerging market status. The move will mean S&P's range of equity indices, which are used as benchmarks by active and passive funds, will be rebalanced to reflect the reclassification in September 2014. Vincent, how did Greece get to this stage, and did this have much impact on the markets?
I think it went kind of by the boards. I think realistically, since the advent of the European financial crisis, more or less in 2011, I think in investors' minds, and if you look at the way the fixed income and the sovereign debt of Greece traded, it was really trading more like an emerging market than a developed market. So to be officially called one is kind of a kick in the pants, I think, but from a realistic standpoint or a practical standpoint, I don't think it had a tremendous impact. I mean, if that were an economy like Spain or Italy, perhaps that would be, I think, a big different story.
Okay, Vincent, and what else caught your eye this week?
I think yesterday's release of Chicago purchasing managers' information was a big shock to the market. The number was drastically higher than expected, and has led some folks to believe that the future PMIs would be stronger, and that the potential that the Fed might taper sooner rather than later, because the U.S. economy is picking up perhaps a little faster than people had expected. The only takeaway I have from that is that, even being said, the FOMC meeting for December is 1 week before Christmas, and just in my opinion, of course, it is highly unlikely the Fed will do something, the Federal Reserve, FOMC will do something to spook markets 1 week before the Christmas holiday. It would be devastating to retail markets, I think, here in the States.
Okay, Vincent, and finally, what will you be looking towards on the economic calendar coming up next week?
We have factory orders, we have non-manufacturing ISM, productivity, the usual jobless numbers, and the real GDP next Thursday, along with weekly employment reports, and of course what could be an interesting press conference that follows the ECB monetary policy decision on November 7th. Traders are starting to talk about the possibility that the ECB may cut interest rates or announce an additional long-term, an LTRO, long-term repurchase monetary easing commitment, and that has pushed currencies down a bit and potentially might be a little bit of a surprise next Thursday.
Okay, Vincent, thank you for that, and thank you for joining me on the line today. We'll speak to you again soon. Okay, and that's your weekly wrap up for this week. Have a great weekend.